Hello and welcome. Today we're diving into a really big idea, competitive markets. I mean, think about it. How can millions of people, all just doing what's best for them, create an orderly and, efficient outcome without anyone actually being in charge? It seems kind of magical, right? Well, we're going to unpack the powerful concepts that explain exactly that. Let's get into it.
So this is really the central mystery we're trying to solve today. No one person, no single committee decides how many tons of corn to grow, or how many cars to build, or how many coffees to brew in a given year. And yet, for the most part, you can just walk into a store and find what you need. How on earth does this massive act of coordination just happen?
To figure that out, we've got a roadmap. First up, we'll see how a price is born. Then, we're going to ask a really important question. Is the market's outcome actually any good? That's going to lead us right to the famous invisible hand theorem. From there, we'll get into the huge difference between efficiency and fairness. And finally, we'll see what happens when we throw a wrench in the market's gears.
Okay, so let's start at square one. Before we can even begin to understand a whole economy, we have to zoom way in and see how a single market, for just one product, finds its balance. This is where it all begins. And to keep things simple, we're going to use a classic example, a local market for corn. We're not talking about anything complicated here, just people who want to buy corn and farmers who grow it.
So in any market, you've got these two opposing forces. On one side, you have demand. Just think about how you shop. The higher the price of something, the less you're probably going to buy, right? That's demand. And on the other side, you've got supply. For farmers, the higher the price they can get for corn, the more it's worth it for them to grow and sell. These two are in a constant tug-of-war.
Okay, now check this out, because this is where these forces find their balance. Look at the table. If the price is super low, say $100, everyone wants to buy corn, but farmers, not so much. You get a shortage. Now, if the price is really high, like $300, the farmers are thrilled and they produce a ton of it, but nobody wants to buy that much. You get a huge surplus. But right there, in the middle, at $200, something kind of special happens. The amount people want to buy is exactly the same as the amount farmers want to sell. The market clears.
This sweet spot has a name, competitive equilibrium. And the crucial thing to understand here is that everyone involved is a price taker. That just means no single farmer is big enough to dictate the price of corn, and no single buyer can demand a special discount. They all just have to accept the market price. And at that price, everyone is doing the best they can for themselves. The system is in balance.
All right, so the market finds a price all on its own. Cool. But that brings up the next obvious question. Is this equilibrium outcome actually a good thing for society? Is it desirable?
Now, to answer that, economists have a very specific way of defining good, and it's called Pareto optimality. Basically, an outcome is efficient if we have squeezed out every last drop of win-win potential. It's the point where you literally can't make any more deals. Any change you make to help one person would now have to hurt somebody else. It's a really high bar, and notice it says absolutely nothing about fairness, just that there's zero waste.
Let's make that a little more concrete. Imagine we've handed out all the corn. Now we ask a simple question. Can Farmer Jane and Buyer Bob make a trade that makes at least one of them happier without making the other one worse off? If the answer is yes, well then our starting point wasn't efficient. An efficient outcome is just that point where all those possible win-win trades have already been made. And this brings us to one of the most famous ideas in all of economics. Right now, we have two separate ideas, the market finding its own price and this very strict definition of efficiency. The big question is, are they connected? Well, the answer is where the magic of the invisible hand comes in.
This is it, the first fundamental theorem of welfare economics. And this is what Adam Smith was talking about with the invisible hand. It says that the competitive equilibrium we found earlier, the one that just came about from everyone chasing their own self-interest, is automatically, without anyone planning it, Pareto optimal. It's efficient. No one tried to make an efficient outcome for society. It just happened.
But, and you knew there was a but, right? This is a huge one. The magic only works under a very specific set of perfect conditions. As you can see here, the whole thing falls apart if you have a monopoly or if you have things like pollution, what economists call externalities. It also doesn't work well for public goods or when people don't have perfect information. In the real world, these conditions are pretty much never perfect, and when they break, so does the invisible hand.
So the market gives us an efficient outcome. Case closed, right? The market is perfect? Well, not so fast.
This brings us to a really important distinction.
Just think about this for a second. An outcome where one person owns all the corn and everyone else has zero is technically perfectly Pareto optimal. Why? Because the only way to make someone else better off, by giving them some corn, is to make the one person who has it all worse off. So it meets the technical definition of efficiency, but I would think a single person would call that a fair outcome.
And this is where the second welfare theorem comes in with a really fascinating twist. The first theorem says, hey, the market will run an efficient race from whatever starting line you give it. The second theorem says, well, if you don't like where people finish the race, you don't have to mess with the race itself. Instead, you can just move the starting blocks. In other words, society can decide on a fairer outcome, redistribute the initial wealth, and then let the market work its efficient magic from that new starting point.
The takeaway for policy here is pretty profound. It suggests that if a society wants a fairer outcome, the best way to do it isn't by messing with prices, like with price controls. The theory says it's better to deal with fairness directly, maybe through taxes and transfers, to adjust everyone's starting point. Then, you just let the market do what it does best. Allocate everything as efficiently as possible.
All right, so for our final section, let's see what happens when we do mess with the market's machinery, when we break one of those right conditions we talked about.
So let's go back to our simple corn market and imagine the government puts a small tax on every single ton of corn that farmers sell. It sounds like a pretty simple policy, but it has a huge effect on the market's efficiency.
Now, don't worry about the formula on the screen. The idea is really simple. For a farmer, a tax is just another cost of doing business. So to stay profitable, they're only going to produce another ton of corn if the price they get after they pay the tax is still more than what it cost them to grow it. And because that tax effectively lowers the price they receive, it's just not worth it for them to produce as much. The entire supply of corn shrinks.
The result of this is something economists call deadweight loss. That tax creates a wedge. The price buyers pay goes up, and the price sellers get goes down. That gap in the middle represents all the win-win trades that could have happened, but now they don't. You know, a buyer was willing to pay more than a farmer's cost, but not enough to also cover the tax. That lost opportunity, that destroyed bit of efficiency, is the deadweight loss.
So let's just do a quick recap. Competitive markets are amazing systems for finding a price that balances what people want with what can be produced. The invisible hand theorem shows us that, under ideal conditions, this outcome is efficient, no waste. But we also saw that efficient isn't the same thing as fair, and that messing with the market with things like taxes can break that efficient machine and create deadweight loss.
Which leaves us with one last big question to think about. We've seen the incredible power of the invisible hand in theory, but we've also seen that its magic really depends on these perfect conditions that almost never exist in the real world of monopolies, pollution, and imperfect information. So the real debate isn't about whether the market is good or bad, it's about figuring out when it works, when it fails, and if the invisible hand is so powerful, why do we so often seem to need a visible one? Thanks for joining me.